And they're the panelists. Anybody have favorite seats that they like? No? Big round of applause for the panel. I'll go down here. Sit next to Jeff. All right. Any immediate visceral reactions as I pull my notes out? Darcy, do you think I'm crazy? Comedy's good. All right, Jeff.
Yeah, I hope we're all waking up now.
Yeah, I know. I had to warm them up. All right, let's get that thing out of the way. So let's talk about the polling question, and I'd like to get everybody's reaction to China being the #1 sort of issue out there. And Darcy, I'll just start with you because we talked about it in the green room, which is, by the way, David Letterman never did that. You ever notice David Letterman would never talk to his guests during commercials? That's not me. I'm not David Letterman. But just share some of the sentiments about China. And you mentioned that even there was a story in the Wall Street Journal today about whether or not China's GDP is even real. But from your vantage point, representing both sellers and buyers, what's going on in China, fear in the real estate market today?
Yeah, it was interesting to note that they are now investigating the man that is in charge of the statistics that show growth or not in China. So we may see a whole nother set of statistics coming out soon. I think it's obvious that this audience would respond with China. I think if you actually polled a greater US audience, they might say the stock market, because so many of them didn't have real wealth growth in, that are retirees, et cetera, that are going to be much more worried about that, and the press talking about it every day. China to our market, I think that they've actually been a relatively big buyer of commercial. They've not been they've been a big buyer of development, and they've obviously been a buyer of apartments, but I think we have plenty of other people to fill that void. And
both foreign and domestic?
Foreign and domestic, if that becomes the case. I think there's an awful lot of domestic capital that wishes all the foreign capital would go away. So maybe returns would move up a little bit and there'd be room for them in this market. So I understand it from the audience, but I don't really worry about it.
Okay. So Leslie, when we were talking yesterday in prep for this, it struck me that some of the attributes of this low cost of doing business, and let's put aside low cost of living, but niche markets around the country, like in Nashville, like in Austin, like in Portland, that's the space that you play in, but you do it in the 5 boroughs. So maybe a little bit on sort of what you're doing and how you've created a model for tenants, small tenants, large tenants, to have a potentially more affordable place to do business within the 5 boroughs in New York.
Okay, I'm happy to respond to that, but weren't we going to start with our bios to introduce ourselves?
Oh, I jumped right in.
Everybody knows who you are. The largest female owner of property in New York City.
Boom. But
I'm pretty small. Pretty petite.
But you could explain who you are in the body of the question. How's that, Leslie?
Just for the audience. Well, first of all, I'm Leslie Himmel, and Steve Marengoff and I have been partners for 30 years. We have built a portfolio of B-class buildings. One might say it's like Nashville compared to what Related has in Manhattan. We're privately owned. We've kind of bought property by property, brick by brick, created value by repositioning and renovating these properties. A lot of our properties are owned for 30 years, some with institutions, a lot on our own. So my context is really buying in emerging neighborhoods in Manhattan. We bought at 401 Park Avenue South in 1979 when there were actually prostitutes on the street. 729 7th, another example, Times Square. I remember meeting with Seymour Durst when he was trying to make Times Square happen. It took years. It finally did happen. I guess you would say what we have is, emerging. We have what one would call affordable space. We've been quite lucky in that secondary office buildings, B class, are in. Tenants today, we have Samsung at 26th Street is paying us $55 or $65 a foot, and we're getting actually almost more in our trendy, cool, show the bricks buildings than the glass towers. So it's really interesting how we bought what we could buy as a first-generation purchaser. We didn't do ground up, but we did huge renovations. Another example is 1460 Broadway. And we've created what looks to us like affordable space. It's the $55 space compared to the $100 space for this very large emerging trend of companies that are growing 5,000 to 15,000 feet.
So if you're the emerging markets in the 5 boroughs that you play in, if they're like Austin and Nashville, does that mean that's where all the food trucks are in front of your buildings? I'm trying to find that grilled cheese dude. I can never find him.
I don't know. I don't eat off food trucks, so I can't answer that.
So Jeff, turning to you, and as Leslie points out, you have an opportunity to introduce yourself, but also wanted you to reflect on, as a mixed-use developer, some of the trends there in terms of cost of doing business and cost of living, because you're sort of playing in both spaces, right? So you're developing it all. Are you seeing any sort of headwinds in terms of New York being hard from a doing business or living perspective, where people are saying, no, we don't want to be in New York when you're recruiting tenants and the like?
Jeff, do you want me to introduce you?
Sure, go ahead.
The guy everybody else wants to be.
Very nice.
Josh, does that mean I have to introduce you? Is that how it works, like round
Yeah,
robin?
there you go.
I'm done.
Developing a new city, right? Within our
So
city.
first, thanks for having us. It's great to be here today. Well, let me just actually back up on the China thing, because I literally just got back last night, and I go a couple times a year, and I've noticed some differences over the past couple of years. So I would say about 2 years ago, I came back on a trip, and I brought everyone together in the office, and I said, everything's going to change, because I just got back, and every company that I visited there had a new door with a sign on it that said outbound investments, and nobody worked yet in those offices. And they were directed to set up those offices and begin hiring, right? So you saw this massive trend about to explode, and literally, after that visit, we saw it explode here. And so that started the kind of currency moves here and the investment here. This week, I came back and visited with many of the same insurance companies and pension funds and sovereigns. And if you talk to the people in China, we read about China here in the paper, it's in the news every day. If you talk to the people there, business people, they don't see any problem with their economy. So they basically said, China's growing at 7%, which whether it was 8% or 9%, it's probably not accurate anyway, and everything's fine. So they think that all the stories are overblown. They don't see as much of the trouble there. Now, separately, I met with a group called SAFE, which is essentially their Federal Reserve. If you ask the Federal Reserve over there what's going on, they are thinking about currency controls and outbound capital flows again, and thinking about limiting those, right, to address some of the currency concerns. So I think that is a hint towards what's about to come, which would be a slowdown and a reversal of direction. So I would say we should be looking at other places for capital here over the next couple of years, because I do think it's going to it will slow down by government mandate. So I thought that was an interesting trend, and
Jeff, is that political, or is that just basic economics?
Everything there is run, by the government.
Right.
So political is government.
Right.
I mean, every single life insurance company, organization, investor here is effectively a government organization.
Gotcha.
Even if they say they're public, it's 90% owned by the government still. So, yeah, I think that's by government mandate. Right. With regard to your question, I think that New York City is by far the best city in the world to live, work, and play. And I think all those things that you put up there on cost of living, I think it's all interesting, but I think that there's a role for a New York City in this world that will always exist. And I think, yes, we're more expensive, but we are better, right? And people want to be here. Investors want to be here from around the world, and whoever has money at the moment, and it changes all the time. So maybe it won't be China next year, and it won't be the Middle East because they don't have oil anymore, but it'll be somewhere else. And people, and in a way, the more we have global instability, the more money is going to come here, because New York City is just a safe haven for capital. And so I think that continuously drives investment dollars here, drives cap rates down. It forces out some of our domestic buyers, as Darcy said. But then going to the people that have to occupy New York, that want to occupy New York City, that live here and work here, corporations can move to Austin. But the truth is, we have the best pool of talent right here in New York City. And companies are relocating here despite our high costs because there is a shortage of skilled workers in this country, as you pointed out. And kids coming out of school want to come to New York City for all the things that they've always, same reasons, for culture, for excitement, for nightlife. And I think more and more we're starting to see smaller startup companies, the 49 employers, technology companies here. I think technology growth is clearly emerging as one of the great trends out of New York City over the last couple of years. Started maybe more in San Francisco and Boston, but I think New York City has really caught up now, and we're seeing more and more growth in that sector and attracting more and more young people. And I mean, I'll tell you, like, if you think about Hudson Yards, I'll tell you a quick story on that. When we started pitching Hudson Yards to corporations, I remember the pitch vividly. We would talk about how great these new buildings are, and how they're better than the B-class buildings, and they're much more efficient,
Different.
and different, and better, and
Different.
and the air quality was
Not
better,
as cool.
and the mechanical systems are better, but they are more expensive. And we kind of went through that whole pitch, and it was all interesting. And I think we would sell efficiency and cost per employee and kind of all those things. And we got through kind of the real estate people, and we got through the CFOs and with that pitch. But ultimately, inevitably, every single time it got to the CEO's office, you got that blank stare as you were giving that pitch. And what really changed, and we shifted the whole way we present Hudson Yards, is that it was all about the environment, the people. And if you ask CEOs in New York what their biggest problem is, they say attracting and retaining talent. And so the pitch switched from the physical attributes of new buildings to where people want to be, and how are they going to use real estate to attract and retain talent. And suddenly their eyes lit up, and then said, wow, if I can actually move my office here, use that to attract people instead of just paying them more, now I'm interested. And so the whole story of Hudson Yards became,
So if we move there, we don't have to pay our people more?
Exactly. In fact, aren't you looking for office
No,
space?
we're not looking for, Jeff, we are not looking for office space.
So anyway, so that's really, I think that, about using real estate to solve kind of the number one problem for corporations today, I think is really the key to success.
So Leslie, I want to pick up on one of the words that Jeff used, which is startup, and look at your tenant base for a second and just think about those 49 employees and less people, and what's important to them in terms of space and how they calibrate growth. And we talked a little bit yesterday about sort of the model of WeWork and the growth of WeWork and sort of not only your portfolio, but others. Just get your reactions to that.
Okay. First of all, let's talk about what is a startup. When I look at a startup, and my son's here, he graduated Harvard Business School like a year and a half ago, and there are a lot of kids who are starting up, and it's 5 people, 10 people. Those are startups to me. And in the world of our tenants, which are 10,000 square feet really and larger, that's really not a startup anymore. We've specialized in what we'd call the smaller companies. It's not the KKRs that you have, but someone who's renting 10,000 feet at $50 a foot, that's $500,000 a year. That's not a startup, right? But if you go to the other side of that, what WeWork has been doing, and we have WeWork in 2 of our properties, 401 Park Avenue South and then 1460 Broadway. 1460 Broadway, WeWork is living off of a lot of these smaller startup ventures, as well as now starting to rent to a Facebook, if you will, who wants auxiliary spaces for outside of their corporate headquarters. And in that environment, 1460 was a really good example. We took a property, and Skadden Arps had been the main tenant. We purchased it in September of 2014. We were embarking upon a huge renovation, not a development, but a total gut renovation. And our first thought was, we're right near Bryant Park. Let's put in, tenant by tenant, and go to the TAMI industry. And as we started looking at it, we were very happy with what WeWork did at 401 Park Avenue South. We said, well, they are the TAMI industry, and they're subletting, if you will, and living off of that as well as others. And when Skadden Arps was leaving on March 31st, we actually executed the lease that same day due to the incredible efforts of our leasing team, Jason Dacker and Farrell. And it was like a miracle. We thought we were going to take 24 months to lease to individual tenants, which is really what we usually do. And instead, we signed a lease. And we believe that the WeWork culture, their community, it's more than just a sublet of small space. And it's what, their focus, and I know a lot of people in this room are probably interested, why are they different than Newhouse? Why are they different than Regis? They're really different. They've created a community. They have this we live, we work, we play idea. And as you said, that bench was perfect. They kind of have that all, and they're going to roll that out a little bit with the We Live concept. So I think we could have done that ourselves. And so the question is, do you let somebody else, in a way, go into business and spend all the money on the infrastructure for creating communities, fun spaces, kitchens, camps in the summer, classes, lawyers helping, the accountants helping the businesses start? To us, that's an operating business, and we thought it was really smart to have them take advantage of the space, build it out, and then use their community to be successful. But this whole notion of startups, I know it's like a catchy phrase, and we're now, I think, number 2 to San Francisco for VC, which is fantastic. But hopefully, when we see what you would call a startup come to one of our other buildings, like 60s 32nd Street, we're taking 10 or 20,000 square feet. We want to make sure they've been in business at least 5 years. They have a business plan and they're well funded. Because the last thing a landlord really wants to do with startups, if you will, is pay a broker from CB. We're happy to do that, but pay a commission, do the TI, and then have them go out. We're not a lender to startups.
Right.
But we're an investor of office space.
Right. If you wanted to invest in startups, you'd invest in startups. You wouldn't do it through a real estate
Right. But I guess we sort of do
Right.
by constantly building out space,
Right.
don't we?
So Darcy, another conversation that we had in the green room was really dealing with, we haven't had sort of market clearing prices to tell whether or not the China effect is doing anything from a valuation perspective. But you also mentioned that there's not a lot of product on the market. So a little bit of a reflection from you on what the first quarter and maybe what the first half of 16 may look at like from a transactions volumes perspective. And to Jeff's point, if there is some new sovereign nation where capital is coming from, where would it potentially be coming from?
All right. Well, I think the fall showed a bit of a pullback in the city. A lot of product hit the market at the same time that the finance markets were beginning to suffer and have some issues. So it just became it was just a lot of product to shove through a somewhat nervous market. And debt quotes were going from 3.7 to 4.10. And if you're priced pretty thinly, that has a pretty big impact. I think that a lot of my clients, and I understand a lot of everybody's clients, are on the sidelines going, we think we should go, but should we go? And so we're all out there making monitoring calls, and everybody's like, yeah, I don't know. Should you go? And you say, well, would you be there to receive it? And I think so. So it's a challenging time to monitor. We're going to go. We're going to go with 2 pieces of real estate next week, and I'm confident that the market's going to clear them. I'm not. They're both in the probably the $300 and $600 million range, so they're not the mega deal. But I see money from all over the world right now, and I believe at this point that the Middle East is still intending to make some investments here. I believe that Canada is continuing to be an investor here. I believe the U.S. pension systems are all planning to be investors here. So I think that the market's going to handle the product.
Right. So no reason to panic.
So we actually, we took bids. We're doing a recap of our first office building at Hudson Yards. Bids came in yesterday. And I mean, the demand from around the world is just unbelievable. But no Chinese.
And is that a first, Jeff, in your experience in the last couple of years, that they weren't visible at all?
I don't know.
We're doing a deal with a major Chinese.
Right. I mean,
right
having
now.
said that, I mean, we are closing this quarter 2 transactions with Chinese life companies on the development side.
Okay.
So it's, I mean, certainly I don't see that as a huge trend, but I thought it was interesting. We got probably 10 bids to recap and no Chinese in there.
Interesting.
But very strong numbers.
Right. Not surprising, Darcy, when you hear
I mean, the Chinese and many of the sovereigns are the same way, but the Chinese in particular are radically understaffed for the volume of product that is shown to them on a consistent basis. So one of them would say to you that they've learned that they need to, if they have 4 deals they really like, they need to take 4 deals they don't like quite as much, partner one with the one that they really like with one they don't really like, because then they're told, toss one out and it's easy. And so what they really want is a deal that's tied up by somebody else already. They know 100% that if they do decide to do this deal, they can do it. So they really don't want to just go out and generally compete in auctions. They want Scott Reckler to walk in and say, I tied the deal up, do you want to join me? You know, it's that type of situation for them, and it really is 100% just about pure human resources not being able to handle it.
So one of the shifting gears here, but on the topic of affordability and housing, so New York, just from a housing perspective, is something we got a lot of feedback in the survey process about the sustainability of the growth in the housing market. So this is sort of a question to the panel from different perspectives. But Leslie, you talk about emerging New York City neighborhoods. Are you seeing the growth in those neighborhoods also because there's workforce coming from those neighborhoods and there's a linkage between where people live and where they want to work, and those neighborhoods are more affordable to live in? Are you seeing trends like that?
Well, look at Brooklyn. Brooklyn's become its own city. It's not even, you know, my daughter was living in Williamsburg for a while. You see new office developments happening there, and you see a huge amount of new stock being built. You know, Spitzer's building some, Willentis is building some office buildings and residential. So Brooklyn has become its own mini city. And I think we were talking yesterday, has Brooklyn become a new suburb in a way? It's its own, it's its own area. Long Island City, we've owned a property there. I know it's now an emerging market, it's hot. We've actually bought something in 1986, so what, I guess it's a long time ago, 30 years ago. And it's fascinating to see the residential happened a while ago. It's continuing to happen. You have some, you know, Tishman Speyer is building a huge project with residential, which is a huge statement after their office building. I know you're doing an awful lot. Cornell Technion's going to affect that area. So yeah, you're going to have a huge amount of residents that are going to be living there. And then the question is, can the office space do an infill? We own actually a full square block that's leased to the city and has been leased to the city since 1986. Everyone makes fun of me in my office. I see it as a big building one day. I'm dreaming. I
In
know
Brooklyn?
that. No, in Long Island City.
In Long Island City.
It's 120,000 feet of land, and we have a 2-story building on it at this point. I see a big building there one day. We're not far from the center, and you can see the amount of affordability that's, you know, pressing people. Rentals there are probably 30% to 40% less than they are in Manhattan, and there's just, you know, little communities starting in the boroughs. You know, New York City has just become so expensive, but you see the top end of the market, you know, and the billionaires row. I mean, that's crested. I've heard recently there's a bunch of funds starting to buy the groups of unsold shares to help people finish because it's going to get ugly. So I think we've crested the Chinese. You know, we have the 30% of the buyers were coming from the, you know, from Europe, mainly China, Russia, Brazil. It's not happening anymore. So once that spigot has turned off, the very high end has happened, and you know way better than I do. I don't know how that cascades, and then once that starts changing, how does that affect pricing in the office market? So you know, we talk about this a lot in our office. Are we going to get back to basics? Are we going to get back to the you know, back to basics where trees don't grow to heaven, and maybe we're going to be able to buy at a 4 or a 5 or a 6 cap versus an empty building like the Brill building sells for more than perhaps I would get at 729 7th, which is diagonally across the street. It's a fascinating time in the market.
So a question for the panel, just on that theme that Leslie started, which is, so Brooklyn became its own city. Long Island City is, sustainable and a real thing. What's the next thing? If one were to be a pioneer, maybe I'll look at you, Jeff, because you guys build things where there was nothing before. Is it the Bronx, which is 4 subway stops away from where we're sitting right now? What's the next thing that people will be talking about?
I mean, the answer to that has to be the Bronx, because kind of that's
We've run out
the only place
because no one's going to Staten Island. Is that?
I think no one's going to Staten Island.
I was going to say Staten Island.
Look, I think Brooklyn and Queens still have tremendous growth opportunities there. I think everything that we're talking about is great for New York, right? So whether it's WeWork or Neuhaus, allowing tech companies to come here, the growth of office in Long Island City and Brooklyn, bringing kind of opportunities for companies to lease space at a lower cost is great for New York City to attract people, and kind of all this feeds on itself. And the large corporations leasing office space in Manhattan kind of is all good, and it's a balance that you need for a city to be sustainable. So, I think that's kind of natural evolution. Whether the Bronx becomes the next great thing, I don't know. I mean, the Bronx has some fundamental kind of structural difficulties to see that as the future, but people are making that bet for sure. I think there's still a lot of opportunity in Long Island City. I think the number 7 line is actually very interesting, because you suddenly, and we see this from Hudson Yards demand, we have a company right now that we're leasing to at Hudson Yards who's going to put back office on the 7 in Long Island City, right? So think about that. They're going to pay, $90, $100 there, and they're going to pay $20 in Long Island City and split their office. So now they're paying $60.
No one remembers who John Rocker was, which is all I can think about when you said the 7 train. But Google it, people.
By the way, on Staten Island, you think about the New York Wheel, you think about the new outlet mall that's going in there, you think about the fact that 22 million people ride that ferry. There are people making bets down on the waterfront in Staten Island.
Yeah.
We'll watch.
I don't know, Staten Island, Bronx?
Yeah, mass transit, although 4 subway stops from here is a little bit different than getting to Staten Island. So,
for sure.
But if you go with the notion of suburbanication, that's clearly a suburb within the 5 boroughs of New York, because there are single-family homes like there are in Queens, like there are in parts of Brooklyn, and we're seeing that. But I guess to everybody, this education challenge that people are articulating and the cost of private education, is that a real headwind for the millennials as they start to move out? Is that something we see in the 5 boroughs that needs to be addressed?
We've been representing the ECF for years. I mean, I think 12 years now, doing the projects like 57th and 2nd, which has the Whole Foods, and produced 3 new public schools for New York City, up at 91st and First. Those projects, which we are bidding some of those additional ones out now, do produce new schools in exchange for the use of the air rights and the bond funding for the city. And that particular area, 57th and 2nd, has seen a lot of families move in. It's a relatively affordable neighborhood, and you can send your kids to brand new public schools that are now being rated. If you think about the effect at the Hudson Yards or up on the Upper West Side, where you get some new schools, it's going to have a good impact.
Right, and keep people here, right?
I mean, look, the education system is probably the biggest challenge I think New York City has, and it's not just quantity of schools. I mean, we have to fix the education system, and I think that until we do that, you're going to continue to see people move to the suburbs, because they either can't or don't want to pay for private schools. So I mean, that's just a bigger political issue. Right. Just going back on other places, though, you can't ignore what's happening on the Jersey waterfront. I mean, that's effectively another suburb of New York City. In fact, it is the fastest growing suburb of New York. So again, when we see people coming to Hudson Yards, they look at their workforce and where they're coming from.
And the ferry makes that.
And the ferry over there, it's pretty incredible.
Yeah.
And people, you can't underestimate the impact of public transportation and mass transit, because like when we did the KKR deal, they actually went employee by employee. I think they have about 450 employees, exact home address. And their commutation studies showed that their home address to 9 West, home address to Hudson Yards, the average commute time went down 7 minutes. by moving to Hudson Yards.
Just recognize everybody who lives in Fairfield County lies about their commute, though.
But they lie equally on both sides.
That's
so.
true, they lied no matter what.
Picking up on Jeff, 9 million people ride the ferry to work in New York
Right.
City, not including the Staten Island ferry.
Right.
Right. I think
It's a
that's
big
going to be a
growth
huge.
area.
Yeah.
I think that's going to increase.
I know Felix and Sarah, we need to go audience questions now. I'm just gonna, as the audience is getting ready for questions, when I was doing this in Los Angeles, and we're talking about downtown Los Angeles, which is a phenomenon, if you haven't been there, you gotta check it out. And we talked about the lack of mass transportation. They said that the mass transit problem in Los Angeles was fixed with 4 letters, Uber. And question for you guys, just as a jump ball, is Uber a positive disruptor in terms of solving some of the logistical mass transit challenges that we have in the city? Or is that an LA thing because they're just so stuck in cars, they don't care who's driving it?
I think we need more 7 trains.
More
Yeah,
7
You really
trains,
need,
yeah.
you gotta get
Yeah.
more subway bus going.
Uber's great, but I was recently at an executive committee at Rebney, and the mayor was late because of the traffic. I mean, really?
That's redundant, isn't
I
it?
know, exactly, right? But the traffic here is a problem.
Yeah.
Right, and that, I don't know if the congestion pricing
Right.
would fix that, but a lot of people say it's partly because, well, one, you got all the cranes around, but you got Uber, which is a
Yeah.
good thing in a way for development.
Right.
But you just have, what,
We're not
10,000 cars a day in addition.
We're not
so
fixing
it's-
it.
yeah, we're not fixing it.
Questions, are we doing that? There's one right here.
Dick Anderson, New York Building Congress. Even though we talked about how much office development there's been in recent years, and we're at a 25-year high in office development in New York City, we're still far behind other world centers. What would it take to really take a leap forward in office development in New York City?
So you're right. I don't know. I remember the exact statistic, but something like over 60% of the office buildings in New York City are over 50 years old. And if you compare that to other kind of world centers, we are far, far behind. Now, I think the best thing that happened probably was done by Bloomberg and Dan Doctoroff when they rezoned the west side, right? So you had West Chelsea as a tremendous residential rezoning success. And then essentially from Hudson Yards up to 42nd Street, that area is really now all rezoned from manufacturing to commercial. So Bloomberg basically realized exactly what you just said and said, if we're going to compete around the world, because we're now in a global market, we need to provide the space for people to develop world-class, state-of-the-art office towers, not just for today, but for the next 10, 20, 30, 50 years. And so I think that you will see the natural evolution, growth from where we are at Hudson Yards all the way up to 42nd Street. It's really satisfying that demand for the future. Look, the development community needs the things that they've always, asked for. We need incentives for corporations to be here. We need real estate tax abatement for new office development to work. So the things that were done for Hudson Yards are essentially expiring, right? The tax abatement is running out. All the benefits that were there are going to go away ultimately, going to be used up. So that next wave of development will need that down the road sometime in the future.
It is, the statistic is actually 75% of the buildings are 50 years old or older. And I really think what we need to do at this point is it's not realistic to assume we're going to tear all these giant buildings down. And we need tax breaks to really incentivize people to go for major renovations of these assets. Because downtown, you can't even take them down if you wanted to. These foundations can be 5 feet thick. And the cost of demolition would just overwhelm any project. So I think we got to get back to a real incentive program for major renovations. Because a lot of buildings have good bones. They just are old.
Well, having been an owner for a long time of these 50-plus old buildings, it's interesting, the brick and the way these buildings were built, they're fantastic. And we recently had a tenant from San Francisco that wants to do a joint venture with us and buy a property. They're a really big company, and they only want to be in a brick building that has character. So if, and I think Darcy's right on the spot, if we had better incentives, 1460 Broadway, we're basically rebuilding the building. We're spending, a fortune per square foot to totally regut the infrastructure, the elevators, the mechanicals, we didn't get a tax incentive, it would be very helpful if we had, because you do need to rebuild oftentimes the elevators and increase the electric capacity and just make it, more modern. But so you want to give owners, a lot of people in this town, they look at real estate as a, I don't know, a trading sardine. They're in, they're out, it's the private equity funds. But long-term owners do invest, and if we had some tax incentives to invest, it would help, renew the building stock. So, because it's really not practical to try to take a building down when you have tenant leases that go for 10 years. It's hard.
Question right there.
Hi, Anissa Keith. I'm with a multifamily firm called BRP Companies. I have a question. Do any of you think that the recent changes with FERPTA will have any effect on residential properties or on property in general in the New York area?
I mean, generally, I would say that unfortunately, none of the sovereign wealth funds qualify.
Right.
So Norges doesn't qualify. Doesn't make any difference to them. Who it will affect are more of the German funds, the Dutch funds, and the question is, given the instability that has crept into the market, are they suddenly going to staff up and come over here and, make some big bets? So I think if we get back to some level of stability, we could see them return and make some buys because they really didn't want to be 49% partners and they would like to be 100%, but it may be better for us in the next cycle versus this one.
Yeah.
I mean, I will say, though, that tax on foreign investors has a pretty significant effect on their decision-making process.
Oh,
And, FERPTA, this was one step. We're hopeful that in coming years, that goes even one step further, that the people that are now exempted is still pretty narrow, and it basically says pension funds, and it's not even clear who is a pension fund under this law. So, I think it will need some more change, but that elimination, I think, would bring more capital into the United States for sure.
Felix, how are we doing on time? We're good? All right, more questions are good? Awesome.
Yes, hi, good morning. Oops, sorry. Hatsanu Bhattacharjee with Princeton Realty Group. Talking a little bit about urbanization, didn't hear too much about distribution, how we get products and services into the city as we continue to increase density. Where do you see that kind of playing in, given the erosion of the industrial stock? Just wanted to get your opinion on the panel.
I mean, if you look at the Amazon building on 34th Street, they have Amazon Prime now. What did they find to be their biggest driver? Walk-ups. Because people now can say, I want a delivery in this 1 hour window when I'm home. They have a system where they're bringing in 2 giant panel trucks a day, and they've got all these vans moving it through. They're mostly bringing it in through Long Island City or Jersey. They have 2 different destinations. Would they love to have more here in the city? Yes. Would they love to have more crosstown streets that are zoned for the commercial trucks only? Yes. But it's, it is a challenge, but they're learning to figure it out and to deal with the city. So
The bigger issue that we heard a lot of, and we're probably going to cover more in Emerging Trends 2016, is the impact of last mile delivery and people wanting it immediately on multifamily landlords and on office tenants, because people are delivering it to their building and buildings now have to deal with storage. And if people can't deal with storage, they're delivering it to our office. And I have colleagues sitting in here. A dude before Christmas on my floor bought a 60-inch flat screen and had it delivered to the office. The poor guy who pushes that cart, his cart is not big enough for a 60-inch flat screen, but that's what people are doing because they don't know where else to deliver it. So we have to figure out warehouse distribution in the city if people want things like that. We just don't have the infrastructure for
there's
it.
a lot of multi-level basements in downtown Manhattan with a lot of loading facilities that could actually be repurposed.
Yeah,
So
yeah,
if it was zoned properly.
right.
Many of those buildings have 5 levels below grade, and at least 4 of them are not in use.
There you go. Other questions?
Can I just, Jeff, I love what you guys
Did
are
I
doing.
say Darcy can ask a question?
All right, can't help myself. Because it came up on residential. I love, you're kind of almost doing a WeWork-ish thing where if I move into a related building in one location and halfway through I decide I'd really rather be in Chelsea, I can get in touch and say, if you have an apartment in Chelsea, I want to move there and you let me do it.
Right.
which is very, very different, and I think would be super great for the city if that was more the trend of that ability to be really flexible. Your company moves, you move.
This is like an advertisement for
I'm
Relay
sorry,
Day.
but I thought that was great.
She wants a listing, you know that.
She gets them all anyway. Look, we have really tried hard to differentiate our residential product throughout New York, and we take a lot of our cues from the hospitality sector in terms of customer service and training and responding to market trends. I mean, I think one of the best examples, we built a building on 42nd and 10th called Mima. And this really followed. If you think about who would live over at Mima, it's in the age group and the demographic, and how do you respond? How do you build a building in response to what they want? So we built slightly smaller. These are rental apartments. We built slightly smaller apartments there, and an enormous amenity space. So we have almost 50,000 square feet of amenity space, and it has everything in there from health club to pool to computer rooms and hangout rooms and pool rooms. But the most interesting thing I find is I stopped by there the other night after a dinner, so it was probably 10:30, 11 o'clock at night, and this 50,000 square feet of amenity space is packed. In the middle of the week, 10, 11 o'clock at night, people want to hang out and socialize and be downstairs in common area and just be with other people and exchange ideas and talk. And I think that's so reflective of kind of the WeWorks mentality, the way people work today, the way office spaces are being built out. And so I think you just constantly have to be on top of trends and demands, and then real estate needs to follow, right? We follow what's going on in the market.
Do you have a pet spa there?
And we do have a pet spa called Dog
Something
City.
better, yeah.
We do. So
And a pet spa. Questions? We got one? Oh, there we go.
Yeah, can you talk about what you might see as challenges going ahead, each of the three of you, particularly for New York City?
Infrastructure is clearly a challenge,
Infrastructure.
but it's an opportunity to create jobs and spend money, and keep the average New Yorker employed, which we obviously need to do. When you talk about construction, we need construction jobs. We absolutely do. So being able to spend in infrastructure, we got to find the money, but it's a good thing to be able to do. Education we've talked about. I'm a big fan of the charter schools and believe that that's an area that we have to be supportive of. Sorry for those in the audience that don't agree. And I do think that aging building stock is really critical. I mean, I had a Chinese investor come in, look at a building on 1980s construction, Olympia, New York project, and guy gets out of the car and he goes like this. Old, no, gets in the car. I'm like, ah. So we do have to face that.
Yeah, I think none of us have talked about the kind of the elephant in the room, which is staying safe. Nothing more important. 2001 was pretty scary. We feel safe, but the world is complicated. I know in your study, cybersecurity has become a #1 concern for CEOs. And so I think as long as we can keep our city safe, and we've been doing a great job of that to date, but to me, that's the most important thing.
I agree.
Yeah. And one thing I'll pile on cybersecurity, the thing about the real estate industry and cybersecurity is they don't think it pertains to them because all the headlines are about retailers and the like. But think about what information you guys have. You have residential tenant information like social security numbers. You have private companies, financial information that isn't public. And to the extent that gets out there, the reputational risk for companies is awful. So we definitely think cyber risk is a big issue for 2016. How are we doing? Is this the last one? This is the last question. This dude down here has got it. You win.
I have a loud voice.
Or
I could
lose.
shout
You may
it.
If it's a multi-part question, that's not going to be okay, though.
But you got to
Now,
end on a good note.
Curious about you were talking about reusing existing housing stock. Where do you see or office stock? I mean, where do you see the best areas for that being?
Well, look, right now, if you look, there's been actually a migration out of Midtown into what I would call South Midtown, Hudson Yards and the like, even into downtown and now to Brooklyn. So I think much of the stock that could really use a major refresh is in Midtown. And you say, wow, Midtown tax breaks, but I think it makes perfect sense because it's going to take a while to put them into effect. It's going to take a while to do the renovations. And therefore, really attract the tenants. Not that they're all leaving, but I'm just saying, refresh that area. Downtown got a major refresh as a result of 11 and Sandy. Midtown South has had a major refresh just because it was originally cheap and people could afford it, but Midtown has remained relatively expensive, and therefore it's harder to fund it.
Yeah, I mean, any specific areas in that area in Midtown that you
What's
see?
an address? Where's
Yeah.
Any addresses?
I'll let you know next week.
Maybe an IP address also.
Darcy, we'll buy it, we'll repurpose it, we got a deal. There you go.
No, I don't have a specific.
Yeah. I think, Phil, we're done? One more question. Wow, that dude did not win the prize. You want an SAT word? That was the penultimate question. Working with the kids at home on SAT prep.
Sasha Durkin, Turner Construction. What about resilient building? 70,000 buildings are going to be affected, and it's complicated.
Resilient building.
So I think the industry learned a real lesson post Sandy, and certainly in new construction, you've seen huge modifications to the way we think about buildings, resiliency, where kind of mechanical systems are located, flood proofing. Yes, I mean it was a huge wake up call, I think, to developers. I mean, certainly at Hudson Yards, it comes up in every discussion with tenants. What happens if there's another Sandy? And so we've designed those buildings to be out of floodplains. We designed them to have mechanical systems above any issues. But the next thing probably won't be a Sandy. It'll be something else, right? So you really just have to think ahead and try to imagine all the possibilities.
That's it? All right. Thank you all. Thank you, the panel. Thank you. Appreciate it.